All right, today we're diving into a pretty wild theory that comes from an analysis of the 2014 European banking crisis. The claim that while one massive bank was publicly falling apart, another one was secretly testing the very technology designed to replace the exact system that was failing. So yeah, let's get into it.
So the analysis we're looking at kicks off with this exact line. And man, it just pulls you right in, doesn't it? The whole idea is that the public story, the one you saw in the news, was maybe just a distraction. The real story, the one that mattered, was happening behind closed doors, locked down by non-disclosure agreements. So before we get to the secret stuff, what was that public story?
Okay, first, let's set the scene with what everyone saw happening. We're going to rewind the clock to 2014, to a huge financial crisis that sent shockwaves all across Europe. And the epicenter of it all was in Portugal.
Think about this number for a second. 3.6 billion euros. That was the absolutely staggering loss that Portugal's second largest bank just announced to the world. And look, this wasn't some minor stumble. No way. This was a catastrophic failure, so massive that nobody could ignore it.
The fallout was fast, and it followed a playbook we've all seen before, right? First, you get the shocking announcement of these huge losses. Then, the government has to jump in to stop the whole thing from completely collapsing. And finally comes the bailout, creating a new good bank. They called it Novo Banco, and pumping it with nearly 5 billion euros. This was the official timeline everyone was following.
But here's the thing. The collapse of Banco Espírito Santo, or BES for short, wasn't just a Portuguese problem. It was a massive warning shot for the entire continent. It basically revealed that the old system of correspondent banking, that network where banks hold accounts for each other to move money across borders, was dangerously brittle. It just wasn't built to handle a major shock. And that problem right there, that's what sets up the rest of this entire story.
Okay, now, this is where the theory gets really juicy. According to the source, while all eyes were glued to the public drama, a completely different story was unfolding in parallel, one that was totally shielded from view.
So you've got these two things happening at once. On one hand, you have the public headlines, banking bailouts, economic crisis, all that painful stuff. But on the other hand, there was this alleged secret track, where major European banks, and specifically Santander, were already quietly testing Ripple and its digital asset, XRP, all under super strict non-disclosure agreements.
And this quote is supposedly the smoking gun. The source claims this is the exact language from internal documents. Now notice what it doesn't say. It doesn't say we're exploring crypto or we're innovating payments. No, it says they were assessing a solution to meet Basel III liquidity standards. And that's a new, really strict set of global banking rules that were forcing them to make cross-border payments way safer. So you see, this wasn't some casual exploration. This was a mission driven by compliance.
And these weren't simple little tests. The analysis shows just how rigorous they were. They were simulating key currency corridors against those new Basel III rules. They were benchmarking XRP settlement time, T+0, which means instant, against the old system's 2-day delay. And crucially, they stress-tested the whole system under the exact same conditions that were breaking the old one.
So the big question is, right? If this was really happening, why didn't we hear about it? Well, the theory is built on the idea that the entire operation was hidden in plain sight, just disguised by that kind of corporate jargon that's designed to make your eyes glaze over. So let's decode some of it.
Okay, here's the first term, allegedly pulled directly from the NDAs. Protocol Agnostic Bridge Asset. It sounds really complex, super technical, and frankly, a bit boring. But what does it actually mean?
Well, according to the source, it was simply code for XRP. By using language like that, they could talk about the asset's function as a neutral bridge for value without ever having to use the word cryptocurrency, which would have set off all kinds of alarm bells.
And here's another one. It's a total mouthful, designed to sound like any other piece of regulatory compliance text. It's technical, it's specific, and once again, it points directly back to those new Basel III rules.
And what's the decoded meaning? This was the entire point of the project, building new payment corridors using Ripple's technology that were specifically engineered to satisfy those demanding new international banking regulations. This wasn't about innovation for the sake of it. This was about survival.
Okay, so this raises a really key question. Of all the massive banks in Europe, why was Santander allegedly at the center of this secret trial? Why were they the ones chosen to test this potential new backbone for the entire financial system?
Well, the source lays out a really compelling strategic case. Santander had massive exposure to the fragile Eurozone. At the same time, they were a powerhouse in Latin America, especially in places like Brazil and Mexico. This meant they were heavily reliant on the exact kind of cross-currency corridors that the new regulations were making incredibly difficult and expensive. So if you wanted to test a new global liquidity solution in a real-world high-stakes environment, Santander wasn't just a good choice, it was the perfect one.
So how do all these pieces fit together? Was the BES collapse and the timing of these secret Ripple trials just a massive coincidence? Or, as the source alleges, was it all part of a much bigger, grander plan?
The core theory really unfolds in just 3 steps. First, you have a public crisis that exposes a fundamental weakness in the system. Second, new regulation comes down, forcing banks to find a new way to operate. And third, a prepackaged solution is quietly tested behind the scenes. Crisis, regulation, solution. See the pattern?
To bolster this whole theory, the analysis points to a few more signs. There's an alleged internal Santander memo from 2015 calling Ripple essential for their Basel III modeling. Then there's a 2016 European Banking Authority draft that seems to describe Ripple's system without actually naming it. And there are even private workshop notes that show how the public story was deliberately kept simple. It was all just about making remittances cheaper.
And this contrast perfectly sums up the two narratives. The public story was simple and sweet. We're innovating to make sending money home cheaper and faster. But the alleged reality was way more profound. We're secretly building the plumbing for a new global financial system because the old one is on the verge of collapse.
And that's where we're going to leave it. The source material presents a really compelling, if unproven, story. But it forces us to ask a much bigger question, one that goes way beyond this single theory. When we see a new financial innovation, is it always a proactive leap forward, or is it sometimes a desperate reactive solution to a crisis that we never even knew was happening? It's a question worth thinking about.